Hi there. Are you feeling overwhelmed, trying to decide if it's better to rent or jump into home ownership? And then, how do you choose the right mortgage? Then this episode of Home Buying 101 is for you, and hopefully these tips will help you save money and avoid stress down the road. Let's dive right in. First, are there still advantages to owning versus renting, even if the cost of rent is less than the monthly mortgage? Yes, and here's why. Advantage one is you build equity, not someone else's wealth. We have a saying in the real estate business: stop paying your landlord's mortgage. Every rent check you write helps your landlord grow their investment. Why not start growing your own? Advantage number two is to lock in your monthly payment. While rent keeps rising, a fixed rate mortgage means stable housing costs and long-term financial peace of mind. Advantage three, make it yours. Say goodbye to lease restrictions. Homeownership means freedom to customize your space and truly make it feel like home. Want to add an accent wall? Go for it. It's your house. Advantage number four, tax benefits and financial advantages. Mortgage interest and property taxes may be deductible, putting more money back in your pocket during tax season. Advantage five, start building wealth now. Owning real estate is one of the most proven paths to long-term financial growth, and the sooner you start, the more you gain. So now, you've seen the advantages to home ownership, so let's talk about the top 4 factors to consider when choosing a mortgage and one important step you should take before calling that first mortgage lender. Budgeting. I've said this before in previous episodes. It is so important that you sit down and figure out what you're comfortable with, all in, for a mortgage payment. You may qualify for a $600,000 house, but you may not want that payment that comes with it. So I tell all my buyers to figure out what maximum monthly payment you are comfortable with. And keep in mind that your mortgage payment is broken into 2 parts that equal what is known as PITI. First, the principal and interest, the PI part. If you have a fixed rate mortgage, your principal and interest will not change, unless of course you recast your loan. Number 2, taxes and insurance. These 2 numbers are the escrowed part of your mortgage payment, and most likely they will change every year. This is why it's so important to keep an eye on your appraised property value when those tax notices come, and to protest it annually, and your home insurance premium, and shop companies if necessary. Factor 1 when considering a mortgage, the down payment. We're going to dispel a myth right off the bat. A lot of people still think that you have to have 20% saved up for a down payment, and that's not true. The minimum required down payment for an FHA loan is 3.5%, and conventional loans require 3% or 5% depending on the program. If you're a veteran or you find a home in a USDA loan area, those are zero down loan programs, along with some private programs such as South Star Bank's HOPE program. If you have 20% or more to put down, that's great because you're going to avoid private mortgage insurance, also known as PMI, which can potentially save you hundreds each month. Another option to think of, especially if you have a big bonus, proceeds from the sale of another property, or another lump of cash coming in, is to buy with the minimum required down payment, and then when your extra cash arrives, do a loan recast. A recast allows you to apply a lump sum to your principal. The mortgage company recalculates your payments based on the new principal balance. There are no closing costs and the terms of the loan stay the same, so your interest rate stays the same. It can be a useful option for many. There are also low or no down payment programs, so having a good lender who will explore the options can make a huge difference for you. Just be sure you understand the full picture, including the PMI and long-term costs. It's not every day you get a mortgage, so remember, there is no such thing as a dumb question. So ask away until you feel like you have a full understanding of your options and what all the jargon means. Factor 2, the type of lender. So you've got choices. There's banks, credit unions, online lenders, and mortgage brokers. Banks are familiar and convenient, but the big national banks have a less than favorable reputation when it comes to communication and closing on time. I know when I get an offer as a listing agent and the loan is through one of the big banks, I am grilling them about their availability, their history of closing on time. Credit unions might offer lower fees to their members, and to online lenders, be sure they're accessible on evenings and weekends. Ask about their relationships with local appraisers, and just make sure that you are going to be able to get a hold of them. That's probably one of the biggest things with these online lenders, is getting passed around from representative to representative. Local mortgage brokers shop rates and programs for you, and that is personally, from my experience, that's my preference. I have dealt with all of them, and my local mortgage brokers, I call them my lenders, I love working with them. I have a list of preferred lenders, as I'm sure you figured out, and my criteria is very simple. I want great communication, I want dedication to finding the best program for each buyer, and I want to know that their priority is your satisfaction with the process. So let me know if you'd like my list. I'm happy to send it. Factor 3, the mortgage term length. A 30-year mortgage is pretty much the typical mortgage length. It does have lower payments, and you need to know that you will be paying more in interest over time. The caveat to that is you take the one with the lower mortgage payment, and when you have extra money, make extra principal payments. Paying one extra principal payment a year is said to knock off 8 to 10 years of your mortgage. And you also have the choice of a 15-year mortgage. Because it's a shorter term, your payments are going to be higher, but normally your interest rate is lower and you build equity faster. So think about your long-term plans. Is this a house that you plan to own for the next 20 or 30 years? And again, goes back to step 1, figuring out your budget. How much can you comfortably afford each month? And please do not let emotions take over when you see a property that puts your payment higher than you want to be. Factor 4, interest rate type. You can go fixed rate or adjustable rate, also known as an ARM. Fixed rates stay the same for the life of the loan. They're predictable and steady. Adjustable rates might start lower, but they can rise, sometimes a lot. If you're staying long-term, fixed might be safer. And remember, when rates come down, you may be able to refinance your loan balance with a lower interest rate. But if you plan to move in a few years, an ARM could save you money up front. Now, there are lender programs that do what they call a lender paid buy down. So let me know if that's something that might interest you. It's a 2-1, which means that the interest rate the first year is 2 points lower. Then the next year it goes up a point, and then the third year it fixes for the interest rate. So let's say you get a loan at 7.5. Year 1, it's going to be a 5.5. Year 2, it's going to be a 6.5. And the years 3 through 30 will be 7.5. There you have it, the advantages of owning a home versus renting, and the 4 smart things to think about before you lock in your mortgage. If you're not sure which loan fits your goals, again, I do have a great list of preferred lenders with a myriad of programs that are here to help. My job is to provide you the information to help you make confident, informed decisions every step of the way. So thanks for watching. Happy house hunting, and be sure to tune in next Friday. Hit that subscribe button and share this episode. Have a great weekend.